Right then, good morning everyone on Thursday the 29th of June as we head into today's European trading. Yesterday I was speaking about the forum, ACB's economic forum, where we had the panel discussion between the heads of the four major central banks. We obviously had Christine Lagarde, Jerome Powell, Andrew Bailey and Japan's Governor Ueda. Where I mean it's kind of a bit of a pointless discussion, really. To be honest with you, I think the highlight of it was the way cracking some jokes. But apart from that, they just reiterated their hawkish stance, which was expected. Nothing out of the ordinary, And you can see here, Asian shares fell on Thursday after global central banks reaffirms their resolve to beat inflation. But what else were they going to do? What else were they going to say? Just be like, oh, they're not going to come out and say, oh, we're going to start cutting interest rates at the end of the year. No, they've got to reiterate their firm stances. Say they still need to get inflation under control. And, they have suggested that, policy is not restrictive enough, and also it has not remained restrictive enough for long enough. So still got more rate hikes on the way, and then when those rates get hiked, we need to stay at those levels for a period of time in order to allow inflation to come down. Obviously, once inflation starts coming down, they will probably look to hike or look to cut interest rates. You'd imagine at some point once the economy's all slow drastically, but we're not there yet. We're still in the midst of high inflation, which is something we still have to deal with at the moment. So expect more interest rate hikes. When they are hiked, we're going to have to wait to see their effect. But apart from that, you can see bearish bets on Asian currencies firm as weak China growth weighs. And obviously if China struggles, with it being obviously the world's second largest economy, but with it having a big bearing on Asia itself, most Asian currencies will struggle when China struggles. So maybe something worth looking at. Not personally something I trade. I prefer to stick to the kind of more mainstream assets on a personal level. But if that is something you look at and something that you like to trade, well, as long as China's growth remains weak, well then those are currencies you can sell. But we have had over the course of the week the Chinese come out and say that they're expecting growth in the second quarter to pick up and be positive. And if we start to get some numbers that correlate with that, well then if Asian currencies sell off when China performs poorly, if China starts to perform better, well then you know what the deal is with that. So if it is something you look at, maybe keep an eye on those Chinese numbers, see what you can find in terms of those Asian currencies. Apart from that, not really a great deal out over the course of the evening. You can see over here US yield curve inversions deepen, which obviously isn't good as yet, as Fed signals higher rates. Several parts of the US Treasury yield curve have reached deeper levels of inversion, a sign that bond investors are increasingly worried about an economic slowdown as the Federal Reserve looks set to hike interest rates further, which is sort of unsurprising. I mean, that's exactly what they said at their last meeting. Inflation still remains sticky, so they have to continue hiking interest rates. Powell did suggest yesterday that the labour market is what is driving markets forward at the moment. Driving the economy forward at the moment. So the labour market remains strong, and as long as that remains strong and inflation remains high, they still have the green light to go and hike interest rates. So once unemployment doesn't rise drastically, they can really do what they want in terms of hikes. You would imagine. Obviously, if companies are feeling the brunt of it, they will start laying off staff members, which then obviously becomes a problem, but we're not there just yet. So but apart from that, bond yield or the yield curve inversion, if shorter dated interest rates are higher than longer dated interest rates, well then that signals trouble ahead for the economy, which is obviously what we are expecting globally at this moment in time. Over to the grid, you can see not a lot of price movement really, no matter where you look. You can see US equity futures couple up, couple down, but the highest up or down is 0.08%. You can see European equity futures, the highest up or down is 0.09%. The Hang Seng down 1% off worries to do with China, but apart from that, everything else is flat. Commodities pretty flat, extremely flat across the board. Bond yields, slightly. You can see the yield curve inversion here. You can go 4. This is the 2-year yield on the 2-year, 4.75 to 4.36 to 4%. That's 3.74, 3.83 the 30-year. Slightly higher than the 10-year, which is nice, but it is obviously a 20-year difference. So obviously from the 2-year down to the 10-year, the yield curve is inverted. Apart from that, global bonds pretty choppy, but none really up that much, none really down that much. US dollar up. The majority is up, but it's not really up by any sort of aggression. Bit of a positive day on the dollar yesterday, but bit of a follow through this morning. We'll obviously have to wait till the European session opens to see what we can find a little bit later on. But apart from that, you got Australian dollars up. Really no other clear direction apart from euros down, which is maybe slightly surprising at the moment, but maybe due to do with some German inflation later on. But Christine Lagarde did mention they're going to be data dependent going forward. They are data dependent going forward, going on a meeting by meeting basis, and with some inflation prints out of Germany today that will be in focus in relation to European related assets. And we come over to the calendar, and we can see here German inflation 1 o'clock today, which is something we need to keep our eyes on. Now, German inflation expected to rise 6.3 versus a previous of 6.1. The monthly figure up 0.2%, which 0.2% isn't too bad in terms of a monthly figure, but if that does beat consensus, well, then that reaffirms their stance that they need to keep hiking interest rates. I wouldn't say a miss means they don't need to hike interest rates. I mean, they probably will at their next meeting, or then it's near certainty that they will on the next meeting. Obviously nothing's a complete certainty, but probably as close to a certainty as you can get. But if that comes down below 6.1, that should prove negative for euros. But we do have a bit of a front runner to that this morning in terms of Spanish inflation. So keep an eye on this at 8 o'clock at market open. You're expecting a big drop in the yearly figure, but the monthly figure is supposed to tick up. So yeah, we'll have to see. Does that miss consensus or beat consensus? Whatever happens with that today, we'll look for something like that in line with German inflation. We'll hope either both beat or both miss in order to get us some sort of clear direction into the coming trading sessions. But apart from that, into tomorrow, you've got the unemployment rate, you've got inflation figures out of Eurozone as a whole, you've got core PCE out of America tomorrow. So obviously some personal income, personal spending figures, which we will get around to now in a minute. But I'll get around to it tomorrow, sorry. Apart from that, you do have Jerome Powell speaking at the moment. Whatever he decides to say for himself, we'll have to see. He did give his thoughts yesterday. It suggested that ongoing rate increases will be appropriate. Said that policy is not at a restrictive enough level just yet, and it hasn't remained at a restrictive enough level for long enough yet. So still a bit of work to do in terms of his perspective, and he is probably likely to reaffirm that as he is speaking at the moment. But yeah, we'll have to see what he has to say for himself once we hear what he has to say. Equity markets, though, you can see here across the board, what you can see is a bit of positivity yesterday, a bit of a spike higher yesterday in terms of US indices. You can see the Dow Jones initially was lower and then popped back higher, and the Nasdaq popped higher, initially lower due to, we come back to Wednesday, you can see some of these figures. This is what drove the move lower, but in terms of them being negative, I'm not really sure. It was kind of a bit of a random move, but once we got into it yesterday, you can see that move on the Dow Jones at kind of 1-2 o'clock, which is a little bit of a strange move, just down out of nowhere. But you can see the S&P, the Dow Jones, the Nasdaq, the Russell. The Nasdaq and the Russell making an attempt higher, kind of a retest back into these highs on the Russell, it looks like, but not exactly clear direction. You got the DAX sideways, you got the FTSE sideways, you got the Nikkei pretty sideways, although making an attempt through these lows at the moment. So lack of clear direction off the back of yesterday's speech, which they've reiterated their hawkish stances, and you're not getting much downside, which shows you, I think, what you need to know in terms of markets. But apart from that, you look at the overnight. I mean, you look at the Aussie Kiwi flat. You look at dollar Swiss making an attempt higher, dollar CAD making an attempt higher, which is no surprise with dollar CAD making an attempt higher. Obviously, we've alluded to that in recent videos. Euro dollar continues to the downside. Cable looks like it wants to make an attempt at these lows. Dollar yen continues to be the one in focus for me personally, and the dollar index continues to the top side as well. But that dollar yen, we're not going to do too much with it or say too much about it until we reach that 145. Looks like we're going to get up there. Looks like we want to test it, and then once we do test it, we do have to. Once we do test it, we do have to pay attention to it and see how markets react in and around that 145 level. First port to call 145, then 150, but we're far away from 150. So let's keep an eye at 145 level in the coming sessions ahead to see what we can find. Apart from that, in terms of yields, I mean, yields slightly higher. Not exactly a massive move, but slightly higher off the back of that announcement yesterday. Probably they were slightly lower after it, but now they're back higher. So in theory, reiteration of a hawkish stance should mean bond yields higher, but it's difficult to work out. Sometimes markets just don't seem to believe it. Markets just seem to think that they will not hike interest rates. How far they are saying, which seems to be a theme in markets at the moment. Is the market right, or is the Fed right? Reality, market is always right, but there's another saying: don't fight the Fed. So there's a bit of a fight going on at the moment. Be interesting to see who wins. Apart from that, you had oil pop up off these lows, which is a bit disappointing. I mean, I was looking at oil shorts over the last ages. You're looking for oil shorts, but we're down back at this 67 round number. I was sort of hoping that it would continue below. We've had another pop off of it, but now that we've had another pop off of it, last time we got to here, this time we have got to here. If we do not create a fresh high and then do continue to push down from here back towards that 67 round number, that is another clear bearish indication, right? Another clear bearish indication. Is something we need to pay attention to. It does look like a bit of a continuation pattern though, doesn't it? A little bit of a correction and then a potential for a move higher. Whether that's a flag or some sort of a triangle, I'll leave that up to you. But bit of a wedge maybe, but does look like a bit of a continuation pattern. Be interesting to see if it pops higher. But if we fail to breach these highs across here, that does, I think, is a bit of a significant development. If we do get back down towards 67 before we even reach there, again, you're going to have to favour a break, in my opinion, on this asset. Gold we got right over the last few days. Now we were looking at this break and a retest of this level across here, this 1930. Managed to hold. Managed to hold. We do have this little consecutive lower highs with this flat bottom across here, so there was a nice descending triangle that we managed to get through. Did manage to push off of that, obviously in line with the trend. Previously. Couple that with the fact that ongoing interest rate hikes and higher interest rates for longer are negative for a zero yielding asset for gold, so there's a clear fundamental reason for a trend lower. You then get the technicals to start aligning, providing, or you do get a technical setup that provides a setup in line with that fundamental bias. They normally are the best trading scenarios. But apart from that, keep an eye on this Jerome Powell speech at 7:30 today, which is obviously ongoing at the moment. 1 o'clock, inflation out of Germany is the main focus of today. But you got some GDP figures as well. This is the final figures, but expect to see strong growth in this quarter out of the US, 4.2% in terms of the quarterly figure, or GDP price index. Sorry, what am I talking about? GDP price index. In terms of the growth rate, still expect to be 1.4%. We've already had the flash estimates out, so that's why that's not high impact and really probably not worth looking at later on this afternoon. But I'll keep an eye on it anyways. But Jerome Powell, 7:30, German inflation, 1 o'clock is what I'll be keeping my eyes on as we head into today's European trading.